Hi there, traders, and welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. I'm here to bring you the big stories in FX markets and everything FX charts and all that good stuff. Today, we're going to be talking about how big funds are positioning in Forex this week and showing you the commitment of trader report data and showing you what that means and where we can see some potential opportunities. But before we jump into that, I'm going to go through the chart check. We've had some news overnight. Well, let's say no action overnight, right? So we've not really seen any progression overnight in the US Iran war. We've actually seen no action, no real kind of uh, bombings or anything like that. There's no necessarily kind of ceasefires on the table. We've even getting reports from sort of Iranian leaders just saying, via X, Iranian Foreign Ministry spokesperson says they have not requested the resumptions of talks with the US. Intermediaries are conveying messages to the US. Kuwait has effectively made its territory available to the US. But when we go take a look at the additional news coming out of News Squawk right now, we can see that when it comes to the Iran conflict, it says US pause strikes against Iran over the weekend. There is some additional data here, though, just saying US President Trump posted several generated images, including the US striking Karg Island, the US striking Iran, an explosion of an Iranian vessel with the caption "No more engines," and a image of Trump holding a US flag on an Iranian vessel with the caption "It's our oil tanker now." So, although the US has paused strikes against Iran over the weekend, do we think that's going to continue going into this trading week? And how do we see this going forward? Now, because there was no strikes over the weekend, we've actually seen quite a substantial change in the markets. So, for instance, oil prices are down. If we look at Brent crude oil, it's down over 11%. It gapped significantly on the close of Friday. We were trading at $98 a barrel. On the open today, we were trading at $85.50, and now we're trading around about 87.50 on dollars. Now, that is a huge gap down. We haven't seen a gap down like this for a while, since sort of the 22nd of May, where we saw crude prices drop from $104 per barrel and open up around $97.55. So it's almost like we closed that gap, and then since then we've seen huge selling coming in on the charts. So very aggressive positioning here by the markets, assuming that the pauses of military action is almost a premeditation to a ceasefire. They've almost front run the idea that there's going to be a ceasefire between the US and Iran because of the pauses over the weekend. So, because of that, markets are trying to price that effect in. If we go take a look at US bond yields as well, they have gapped lower too. Dollar is a little bit softer because everyone's thinking that this means that there is a potential ceasefire coming. However, does that mean a ceasefire is coming? Absolutely not. I've just spoken to you and took you through some of the headlines where there's been no talks, right? Where we can see, and even US president over the weekend is posting images, several images about striking Iran. So there is a development here where the escalations have obviously continued. We saw crude prices rise fairly sharply over the past few days and even the past couple of weeks. This basically is suggesting that there may be a sort of condition where we are going to see those ceasefires come back. But there's been no actual news to say that the ceasefires are coming back. So that is an interesting concept. The market, like I've always said, is a front running, it's a forward pricing machine. It's trying to price in what is the next sort of outcome. So taking a look at that crude oil price, it's almost like, well, where is the opportunity here now? And is there an opportunity here now? Because oil prices have gapped. Now, if we take a look at sort of it from a technical analysis point of view, and if I was to draw sort of a volume profile from the swing low up to the swing high that we've recently had, we are coming back into this sort of high volume area around about that $85, $84 area. So from a technical perspective, this makes sense that this area here is acting as a sort of mild area of support right now. But can we just buy on that information? No, we have to look at the information as well that we have. Now, for me, it suggests that maybe, if we do see military action resume, oil prices could trade back higher again. We could see oil prices head back to $100 again on crude oil. So we have to be vigilant that is happening. Just because the strikes have paused does not mean that this move here is the move to watch. And it doesn't mean that we should go short in crude oil now. I think that headline is quite interesting, or at least lack of headline. It's interesting to see where the market is trying to price things next, and they are trying to price in that weaker oil at the moment. We've seen obviously yields come down as well, which reflects that maybe we're going to see a little bit of a softer inflation image going forward. But if price does come into this $85 area, find support, and we see still a lack of headlines, maybe even we see some kind of fresh strikes between the US and Iran, I think oil prices could move back higher, and we could see oil prices trading back towards that Friday close. Now, on the other hand, if we did see the announcement of ceasefire talks happening, then yes, oil prices should come lower, right? Because they are higher at the moment because of the situation. So if there's any kind of talks of ceasefires and things like that, it should have the opposite effect. And you can see that reflected in the gap. So if we do see that and we see a break below $85, then maybe we can move towards the $80.30 support area. So keep an eye on your crude oil prices going into this trading week. Obviously still very much impacted by the geopolitical headlines at this current moment in time. But a couple of trading scenarios for you to take a look at going forward. Now, let's get on to where are the hedge funds and where are big money positioning themselves in the market. So if you don't know what this report is here, this is the commitment of trader reports. Now, I'm going to show you a little bit about where you can find commitment of trader reports in the skill of the day and how you can actually download those reports for yourself. But today, or for the big story at least, I'm just going to go and take you through what the positioning is, where we can see some potential opportunities coming in, and then go from there, really. Okay. So to kind of start us off, what I want to go through is essentially the latest report. So let's take a look at it. So what I've got here is a platform called Markets Made Clear. There are other platforms out there. This is just my preferred platform to use. If you want any details on that, just drop a comment in the comment section down below and I can send you a link to Markets Made Clear. But Markets Made Clear put the data in a really clear way and really obvious way so that we can understand what's going on. And what I really love about this data is it shows us, the change in the long and the short contracts. It shows us the extremes that are forming in the market because it kind of aggregates them into different sections. So for instance, we have the commercials here and it gives an index of 36, 18 month and 6 months. What this is doing is it's measuring the amount of net contracts and then taking a look at how that differs between the previous 6 months, 18 month and 36 months. And it creates an extreme if, let's say, the past 6 months net contracts are the lowest, are kind of short the highest levels that we have seen. It will give us a 0% against that previous kind of 6 months. and so on and so forth as the time horizon rises. Let's say net contracts are at the highest they've ever been. It will give us an 100% reading showing that actually net contracts are on the long side of the highest they've ever been, or for at least 6 months, 18 months, and 36 months. And look what we've got here. We've got a few trade ideas because of it. First of all, it does track crypto. You can see Bitcoin, Ethereum, but those markets are relatively young. So when we do get some kind of extreme on those, I tend to take those with a little bit more of a pinch of salt. But what we do have here is we can see the Canadian dollar has an extreme. So we have a 93% reading on the 36-month index. We have a 100% reading on the 18-month index and a 100% reading on the 6-month index. Very interesting. And we talked about the Canadian dollar last week. Even on the euro side, we can see that there is an 100% on the 6 months, 91% on the 18-month. Then most interesting to me is the Japanese yen, because the Japanese yen is in that place of it's at extreme levels, and we're seeing extreme readings from the commercial data. So you're not just looking at it from, okay, well, the Canadian dollar has an 100% extreme, but where is price? It's not really at a major level just yet. But when you look at the US dollar Japanese yen price, it is, right? It's trading up at 164. We've seen a little bit of a sort of move away from that. It did gap down on the open, but that's like most markets at the minute. But yen is typically weaker across the board, right? It's one of the weakest currencies right now. And it's dollar yen in particular is trading towards the October 1968 highs around 164.50. Now 164, we haven't seen, like I said, we haven't seen 164 since 1968, and that's where current prices are. So that is an extreme level. Okay, it's extreme as well because we've seen interventions from the Bank of Japan prior to this. So we saw interventions at 148, 150. We've seen interventions coming in at 162 back in July of 2024. So we are reaching another level of extreme where price is stretched, and we're seeing that reflected in the commitment of trader report data, especially when we take a look at it in a bit more of a granular level. So I've got the Japanese yen contracts here. I'm going to open this out and show you what this is. So the top chart here is a weekly chart of yen futures. So when we talk about Japanese yen sort of long, what we mean is dollar yen short. When we talk about Japanese yen short, that is dollar yen long. Okay, so the chart is just inversed. So when I'm looking at this chart, what can I see? Well, when I look at the commercial positioning, because that's what's giving us the signal, and what I'm going to do is I'm going to just take off the long and short contracts. I can see that the net contracts are at an extreme level. The last time that we've seen these at these levels was around sort of that July 2024. Now we're not quite there yet, but it's heading towards that potential extreme. Okay, now they are at an extreme point over the past 18 and 6 months, but they're not at the sort of 36-month extreme just yet. Now back in July we saw this the net contracts on the commercial side, we saw those at around 194,000 net long contracts, right? Now if we take a look at a breakdown of the long and short contracts, we can see exactly what the commercials are doing. They are increasing their long positions, okay, and they are decreasing their short positions. That's exactly what you want to see as they are seeing a price that comes in cheaper. Now remember, the commercials aren't in the business of futures trading for profit. They're in it to hedge their ongoing sort of business expenditure, right? So for instance, let's say a company does a lot of business in Japan, or Japan does a lot of business in the US. What you will see is that they will use Forex intermediaries and things like that to purchase large amounts of capital, so that they have almost like a stack of cash to be able to do business with, instead of having to like use the exchange rate every single day, and because it fluctuates, they can use predictions and things like that to try and save money. So when Japanese yen weakens significantly, what they are looking to do is they're trying to buy more of it because it's cheaper to buy. So it takes less US dollars to buy that Japanese yen. So that's what they're doing. They're going to do that because they're not in the business to make money. They're in the business of hedging their future positions. So when they see, so think of it as like, let's say you're just a business owner and your most popular product is, a chocolate bar, right? And you see that cocoa prices have dropped significantly, and the price of your wholesale chocolate bar that sells out really well in your store has come down significantly, and it has a great expiration date. You are going to try and front run and buy as much as that as possible because you don't know that in the future the demand for that chocolate bar is going to increase and that you're going to make less profit, right? So that's how it kind of works in that similar sort of vein, whereas you are looking for that value in it. So that's what the commercials are here for. When you look at the non-commercials, they are your speculators. They are the large speculators. They are trying to buy and make profits in the business, and they are also trying to trend follow. They are essentially known as trend followers. They are using macroeconomics and things like that to predict future prices. So if we take a look at the net contracts here, again, they're not quite at the extreme that we saw back in July, where we saw at their kind of lows, they're at minus 184,000 contracts. At the moment, we're trading at minus 152,000 contracts. So we're not quite at that extreme, but nonetheless, hedge funds are selling yen futures at a 6-month and 18-month extreme. So, we're waiting here for that kind of extreme positioning. It almost shows us that we're late to the position, right? This position has become crowded. It is overcrowded. Everyone is short Japanese yen, apart from obviously the commercials because they are buying it because it's so cheap. So there comes a point where this move becomes too stretched, and that's what the commitment of traders reports can show us. It can show us when a move becomes too stretched. And Japanese yen could be a perfect example of this, because not just because of the positioning from the commitment of traders, but also because of the price that it's at, where we know interventions have come in the past. Okay, now this is probably not the oil situation as well. It's probably not helping things either in Japan, because Japan are a large net importer of oil prices, so higher oil prices is not necessarily good for them. So that's why we've seen a little bit of a come down as well in the dollar yen price, because of that kind of oil sort of drop. So looking at this, and we look at the July 2024 contracts, look what happened to price of yen futures back then. So that was, when we go to the dollar yen chart, that was this move here, where we saw a move from that 162 level all the way down into the 140 spot 50. So we're looking for a similar thing now. And I did a blog on last week about talking about positioning yourselves for potential intervention. Well, now we've got an added layer on that. The commitment of trader reports is showing us that this trade is crowded. So what can we anticipate from dollar yen prices in the future? So I always say that when you're looking at the commitment of trader reports, you want to look at that extreme positioning in the markets. You want to see where your large speculators are. What are they doing in terms of contracts? So if I just open up the short and long contracts here, we can see that they are increasing their short contracts, decreasing their long contracts. So they're getting heavily short on Japanese yen futures at the moment. So this to me is a big sort of alert to say, hang on a minute, this yen short trade is becoming very, very crowded now. Is there a point of reversal? Add in the mix of potential intervention, and yes, this could be a good opportunity in the markets, especially for someone like me who likes to trade that kind of sentiment and macro side of it. So that is essentially the alert that I'm looking at right now, you can see we've got a couple of others as well. You can see there's a euro one, but I'm not too focused on this one right now. If we take a look at the euro positioning, again, if I just have a look at the net contracts of the hedge funds, they are shorting euro near extreme levels. Again, quite not reached the extremes yet, which I like to see. I like to see the net contracts get to the previous extreme. But you know, the last time we were around a similar area was January 2025, and euro US dollar then jumped higher significantly. Euro dollar was trading at one. When was that? Back in, it was just here, January 2025. We were trading about the 1.02 handle, and after that came in, we traded all the way up to the 118s. So again, there is a bit there. But looking at the technical picture of euro US dollar right now, you know, unless yields really start to, US yields really start to unwind, the path of least resistance for me right now is down towards that 111.50 handle. Now, I'd be very interested of a reversal there. This is the weekly chart that I'm showing you here. So you can see that this was the low back in the 12th of May 2025, and also the highs of August and September of 2024. So a very strong level of support there. So let's say euro dollar prices continue to drop to here, and you see that positioning getting more and more extreme, then that would be, to me, a strong level to buy from. Alternatively, if price can reclaim above this 114.50 handle, then perhaps then we can start looking for that extreme to play out with a move back up to the 118s. You know, we have discussed the sort of pound one that we had recently, and we did see prices rally from the 131.50 up to 135.50, but since then pound prices have dropped largely due to the political situation in the UK and the change in hands of leaders in the government. So really speaking, I like a lot of the signals here, but I think the Japanese yen one just has the stronger weight behind it at this current moment in time. So let's move on to the skill of the day. The skill of the day is where I show you something in the markets what you can use. Now, because we're talking about the commitment of trade reports, I'm going to show you where to find it. Now, this version that I'm using here, this platform, it's called Markets Made Clear. It's a paid platform. You have to pay for this information, because what they do is they take the commitment of trade reports, they make it easier to look at. Because I'm going to show you what the commitment of trade reports look like. Now, if you want them free, they are released free. If you go to the CFTC website, okay, and you can come to there's an area on the left hand side here which just says commitment of traders. If you click on that commitment of traders, you get this page here. It says the commitment of traders report. You've got lots of information that you can go through, even kind of like an introduction and the classification, some frequently asked questions about contracts, the types of reports that you get, and so on and so forth. So let's just take you through a few of these. Let's take you through the types of reports that you get when it comes to the commitment of traders. There are four main types. So the first one is legacy. The legacy reports are broken down by exchange. These reports have futures only and combined futures and options reports. Legacy reports break down the reportable open interest positions into two classifications, so non-commercials and commercial traders. So that's something we touched upon earlier. Your non-commercials are your large speculators. They're in the markets to make money. Your commercials are there as hedgers. They are there for business purposes. You have, and those are the ones that you kind of focus on a lot in the markets. So we'll be looking at sort of legacy reports as well. The supplemental report includes 13 select agricultural commodity contracts. So if you're trading sort of agriculture contracts and things like that, then that's going to be something that you will want to look at in terms of the supplemental, and that breaks it down into three classifications: non-commercial, commercial, and index traders. And you have the disaggregated. So the disaggregated reports are broken down by agricultural, petroleum and products, natural gas and products, electricity, metals, and other physical reports, right? So these reports have futures only report and combined futures and options report. This disaggregated reports break down the reportable open interest into four classifications. So producer, merchant, processor, user. So again, that's and swap dealers. That's almost like your commercials. Managed money and swap dealers. Managed money is your sort of like your hedge funds and your non-commercials, and then your other reportables and your non-reportables. Then we have sort of the traders in financial futures breakdown as well. So here we have these broken down as well. Below you can see it's got the different sort of formats that you can have a little look at, and it breaks it down into what it's called long and short format, right? So just to kind of show you an example of that, if I go down to, let's say, like the current legacy reports, and we take a look at the CME, for instance, the Chicago Mercantile Exchange, right? You'll see a long format and short format. Now, if I click on the short format, this is how it appears. It's almost like just text format, like teletext or whatever. If you're from the UK, you're probably familiar with teletext. But it gives you sort of the important information that you need, but it's just in a very, let's say, unorganized way for you to be able to use this information. So, for instance, look at the euro short-term rate. So this is euro. So that is euro short-term rate. If you go down, you've got loads of different ones. You've got lean hogs, live cattle, lumber, cheese, Canadian dollar, Swiss franc, Mexican peso, British pound. So let's take a look at the British pound, for instance, right? So here it says British pound, Chicago Mercantile Exchange, futures only positions as of the 21st of July 2026. Okay, so that is the latest report that came out, right? So the reports are collected on a Tuesday and delivered out on a Friday. So if you look at the date, the 21st was last Tuesday. Okay, so they collect the data, they put the data together, release it on the 24th. So the next sort of collection of this data is going to be the 28th, and it will release on the 31st. So you've got the classifications here. So you've got the non-commercial, the commercial, the total, and the non-reportable positions, long and short. Okay. Then it gives us some more information. It says contracts of pound 62,500, and the open interest is 262,281. Okay. Then it gives you the breakdown. So it says non-commercial longs 64,282 contracts. Non-commercial shorts are 111,000, okay, and it gives you the spread between that, all right. And then commercials, it's got the long and shorts here and things like that, and all that kind of good stuff. Now then you can look at the changes, so the change in open interest. You can look at the changes from the longs and shorts and things like that, right? And the percent of open interest. So what we can see here at the moment is that if we were looking at it from just this overview, we can see non-commercials and look at the shorts. There are 119,000 shorts, but they've reduced those short contracts by 2,495. If we look at the long side, they're at 64,000 contracts. They've increased by 13,197 contracts. So actually, it's showing here that hedge funds are decreasing those short positions, increasing those long positions. Okay, so you can get kind of like a baseline view of what that looks like. Now you can download these in a long format too, which gives you a little bit more information, right? So it gives you a little bit more of information there. But you can also download these as full Excel spreadsheets too. Okay, so the way that you can do that is if you need to come up to the commitment of traders tab here and go to historical compressed. Once you click on historical compressed, it gives you all the years that you can possibly need, right? In different sort of classifications. Okay, so if you wanted the disaggregated futures only report by year, you can have it here, and you can download it as text, you can download it as Excel, and this is really good, especially with the age of AI, right? You can download each one of these, put it all into sort of like Claude or Gemini or ChatGPT or one of those, ask it to pick out the stuff that you need to pick out, and it can kind of build you a little bit of a dashboard, right? For you to have a little look at the commitment of trader reports and things like that. So definitely come and have a little look at this. It's something that I use on a week-to-week basis, on a day-to-day basis. I always check out the reports, but it really helps me come up with trade ideas. It helps me know where I am on the trade as well. So, let's say dollar yen has a really lovely upward trend, which is what we've been talking about. But if I go to the commitment and traders report and it shows me that extreme, maybe if I was trying to buy this trend, I know I'm late to the move. So I'm going to leave it there. Thank you for watching. We've discussed how big funds are positioned in Forex this week, talking about that commitment and trader reports, how to use it, where to find it, how to download it. So thank you for watching, and I will catch you on stream tomorrow, same time, and I'll speak to you then.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.